Well, the latest on Patanjali is that they've received a letter from the Food Safety Authority at Uttarakhand flagging off a couple of issues with regard to the wheat that they've distributed. So you've seen some bit of a problem emanating from there. We'll get a perspective from management as to what's playing out, but more importantly, we'll get a perspective from Mr. Sanjeev Asthana as to how the medium to long-term growth roadmap really looks, because Patanjali Foods at its core is an FMCG company built into a larger brand now, and then you have the stock trading at roughly 18 to 20 times earnings, which is surely at a discount versus peers. So that's how we are looking at Patanjali in a more interesting fashion. Now, in terms of the background of the company, this was incorporated as Ruchi Soya in 1986, of course, folded into that listed company. Market cap is around 37,000 crore. And it's a vertically integrated edible oils and food company. In terms of the edible oil segment, in terms of product line, they do, excuse me, crude, refined palm, soybean, sunflower, mustard oils, and therefore it's to some extent crude linked as well. Vanaspati, bakery fats, frying fats, specialty shortenings. You've got oilseed extraction as well is something that they do. Palm oil plantation operations is what they run. Fresh fruit bunch processing is also what they do, and they do a bunch of oleochemicals as well. So it's a mixed bag. Even within edible oils, it's a very large base in terms of products. Then, of course, there's the big FMCG drive, right? It starts off with ghee, honey, medicated and herbal juices, chawanprash, spices, masalas, condiments, salt, seasonings, and the like. You've got tea, herbal teas, hot beverage mixes, staples like wheat flour, rice, pulses, sugar, dry fruits, and cereals. They do all of that. Biscuits, cookies, rusks, wafers, and baked confectionery is also something that they do. Instant noodles, breakfast cereals, soya protein foods, chunks, granules, flakes, flour, and grits. Nutraceuticals as well is something that they do. Sports nutrition, wellness supplements, vitamins, and gummies. Then there's the larger or the faster growing segment, home and personal care, which is the HPC segment. There they do dental care, toothpaste and the like, oral care, there's a whole range there. Skincare products, hair care, and then there's home care, detergents, dishwash, floor cleaners, hand wash, and the like. The business model, fairly simple, right? As a manufacturer, you buy agri and raw materials. Some of it is something that they source internally as well, process and sell them. They source in bulk, of course. They process, they brand and sell. That's how they're structured. They have 26 manufacturing plants. They sell through 2 million retail outlets, so large distribution reach, and over 8,000 distributors across 97 depots that they have. The geography, of course, India-centric, but to a large extent also exports. They export to 32 to 37 odd countries broadly, globally. When you're looking at the financial metrics and in terms of the revenue growth, there's been a bit of a sluggishness on the growth. Of course, we've seen a bit of a spurt in FY26, but outside of that, it was flatlining, and you saw an 8% growth in FY26. Now, the guidance is that various segments will grow at a different pace. The oil segment will grow at maybe sub 5%. The FMCG, core FMCG will roughly grow at 8 to 10. And then you have HPC, which is the faster growing, higher margin, which will grow at 15. But essentially, that's the guidance. For the moment, that 8% is very close to the lower end of that kind of range. So that's one. Second is EBITDA, and EBITDA has grown at 11%. So some bit of choppiness on the EBITDA number, and that's because of raw material prices, and that reflects on the EBITDA number. When you're looking at PAT as well, that has seen a stronger growth of a very low pace, and therefore PAT has grown at 27% in terms of the CAGR. When you're looking at margins, it's a 4 to 6% kind of margin business at this point, but the potential is there to up it. So again, the oil segment is a very low margin segment. You've got a slightly higher, maybe 8% aspirational margin in FMCG, and HPC is obviously a larger margin kind of a business. So you've got all these three businesses at various margins, but at the moment, again, the margin number looks at the lower end of the kind of potential that some of these products have, and some of these products have generated with other companies. And therefore, we'll wait and watch as to how this evolves, and we'll quiz management as well. Let's look at the balance sheet now. And it's a 37,000 crore odd market cap company, 13,000 crore in terms of book value. So 3 times book is what this one trades at. You've got a borrowing or a liability base of around 2,800 odd crore, all of which is short term, so no concerns there. And then you've got a decent cash and bank balance. So this is good. No concerns with regard to the balance sheet. In terms of where the other concern lies, it's on the cash flow. Cash flow has been very choppy, and that's a bit problematic when you're looking at it. You want something more consistent from a cash flow standpoint, sometimes built into inventories, sometimes built into receivables. So cash flow choppiness has played its part, and therefore we'll wait and watch as to how cash flow unwinds. We'll also speak to management on that. ROCE numbers, well, they're very, very average, right? Around 10 to 16%. Some years it goes above 15, yes, but we're not seeing a materially higher number from that 15, 16% kind of number. And therefore, we're neutral on this one with regard to ROCs. Look at the shareholding pattern, 68% owned by the promoters, promoter group. FI is holding up around 9%, DI is around 11%. The public holds approximately 12% of the company. Analyst view, some very interesting analysts covering this one, and therefore this is something that you should definitely consider. A big thumbs up here. 5 buy calls, no holds, no sells, 60% upside is what analysts are penciling in on this one, including some marquee ones, including Jefferies has coverage on Patanjali Foods. In terms of valuations though, this one trades at 21 times. Of course, there's some bit of discounting when you're looking at the 5-year average because of Ruchi Soya, but for a predominant part of the last 5 years, this has been Patanjali Foods itself, and therefore 21 times is what we've taken as the 5-year average. The 5-year range is between 6 and 41. That range will be skewed because of some component of Ruchi Soya there at some point of time, and therefore, but that's broadly the range. We're neutral on this one as well because the 5-year average is broadly where this is trading. Also, this is trading at 18 times earnings currently. Some bit of margin headwind is what I believe analysts are forecasting, because this is the 1-year forward based on analyst consensus. So something to kind of ponder upon. But broadly 20 times earnings versus some of the other FMCG majors, it's certainly looking like a discount versus others. That there is no doubt about. Of course, various factors play out on that discount, and therefore you must consider all of that. But let me bring on board Mr. Sanjeev Asthana, who's the CEO at Patanjali Foods, to talk to us about exactly what's playing out. Great having you here, Mr. Asthana. Let me first start off with the latest with regard to the Uttarakhand Food Authority flagging off concerns on the product. What's the sense there like, sir? What's happened? Could you give us some, some color around what has happened? How are you going to prevent this going forward?
So thanks for having us on the show. In
Great
terms of the issue that FSSAI had flagged it with the Uttaranchal authorities, was a minor pesticide residue in a particular batch, which has been withdrawn now. And it's a fraction of what we sell in the flour business. Fraction means an extremely small part. In terms of prevention, of course, a lot of work that goes on into the food safety part of it. And the company is exceedingly cognizant of the responsibilities of maintaining the food safety. There's a serious amount of work that we do, and I think the preventive measures will be taken to avert this kind of situation to recur again.
And how are you managing your communication strategy at this point? Is there a risk of litigation? Is there an insurance coverage that you have on any of such risks materializing? Give us some color around that.
So of course, we have all the insurance requirement that any other large company would have. That clearly is covered. But if the point what you're mentioning is that this might lead to a financial liability, that chance is close to zero. The financial liability is limited to the extent of a small batch getting withdrawn from the marketplace. That is just about it.
Okay. And let me switch, because the more important and pertinent question from a macro perspective for Patanjali is the price of oil and the way that is playing out, and raw material prices, how that's playing out in the marketplace currently. Talk to us, Mr. Asthana, what's playing out at this point of time?
So three interesting trends are defining how the raw material prices are going to shape over next couple of months. One is the expectation of the less than the expected rainfall that we are witnessing. Will this year turn itself into a super El Nino year where the rainfall deficit is very high? Will this year turn into international geopolitical situations warranting increase in the crude prices, which has multiple levels and impact on the price of the commodity itself, which drive their value from the crude, but also on the freight rates, on the insurance markets, etc. So that's the second factor. And third, which is an exceedingly critical one, that how the stress that typically is put in, the actions that the government would initiate on certain commodities or otherwise for Essential Commodities Act or others. We saw yesterday that the government has imposed a restriction on the sugar stocks that the traders and the mills can keep. So some of these actions that we have to be mindful of, which is around the food security, which is the government is seized of. So typically they tend to have an impact, but we watch it closely. We hedge our risks. We manage, the supply security consistent with the way pricing is going to play out, and that is not a large source of concern. But we have to be watchful because it also has an implication on the demand side, especially in the rural areas, which depend on a good monsoon, good pricing on the commodities, for their own consumption patterns. So yes, I would imagine that on a rate of on the security of supplies, the pricing at which it is going to come, we will see interesting action on the raw material side, and I think probably the chances are that they're going to go up only.
Yeah, that makes sense. Mr. Asthana, how much of the price hikes have you already undertaken? How much yet to go? What will the margin knock look like? And I'm not talking Q1 FY27. I fully understand you're in silent period. Talk to us about the slightly longer term picture. How does FY27 shape up for you? How is it that you're looking at those trends from an FY27 standpoint?
So Harsh, the issues that are going to drive overall for the next 12 months and where the assessment needs to be done if it's going to continue into the next year as well. So the world is witnessing a very strange weather phenomenon on this super El Nino cycle impacting. Just to give you a brief flavor, the rains in Southeast Asia, for example, seem exceedingly deficit at the moment. Likewise, Australia has already said that the production on the side of chickpeas, which India partially depends on, is going to be just about between 50 and 65% of what they normally produce. And similarly, some concerns of the heat, which is there in US, and all of them have an implication, for India, because we depend a lot on them for various supplies. We look towards the cues from the futures market that plays out in Chicago. So it has an implication overall in the way this is going to play out. And so overall, my sense is that, and what we believe that it's playing out, we will have probably firm to bullish bias towards commodities. It has an implication in terms of, especially the FMCG companies, how much they're able to pass on to the customer. So, for example, in the edible oil, the pass-through is almost immediate, and prices can adjust themselves almost on an hourly basis. When you are selling even the branded products, typically get pretty much priced in, whether on downward slope or even while they're going upward. So that is one part, which is our 70% of the business. But the regular FMCG businesses like biscuits and HPC and food categories that we have, clearly, whether in terms of the packaging material, the raw material prices, the freight rates, etc., will take the cue from how the markets are behaving, and that is where the broader impact the companies will see, that if the price increase is going to impact the demand itself, or some of the competitors we've been tracking in how it has impacted their own portfolios and their businesses. and whether there will be a demand contraction or is it going to reflect back in the profitability of the company. It's early days, but that is something to watch out for. We consistently do a risk assessment of our entire portfolio. So far, it's comfortable, but we'll have to see that how quarter two and quarter three play out right now. And that will depend a lot in terms of next 15, 20 days as to how the monsoons are going to behave, really.
And okay, that's of course a great view that we are getting from you. But let's talk a little bit more medium term. The goal is to get 50-50. 50 on the food and the higher margin side, and 50 on the oil side, right? HPC plus food 50% and oils 50%. And you're growing at a much faster clip. 8 to 10% on food, maybe 15% on HPC. That's really the goal. Tell us if it's different. How quickly do you get to that 50-50?
So it's pretty much same, and the way we look at it. So, for example, if we just discussed about the commodity pricing, if the price of edible oils were to increase per point, per ton basis or per liter basis, so clearly the proportion of the edible oil business will be significantly higher. So we look at the volume as one driver, and we consistently maintain that between 2 and 3% growth rate in the edible oil portfolio. Some bit of revenue additionally comes in as the markets consolidate, especially in the edible oils, where we can get additional, the volume growth will happen to the larger companies. But and the FMCG side, you've pretty much articulated what the stated intent of the company is. But I would imagine if the price of edible oils were to remain stable, let us say we take this as a given to the last year when we had stated this intent, and we maintain the growth rates in the food and the HPC at the stated intent, which we are very much committed to. And this year is looking a lot more positive. We should do it in 4 years' time. We should be very close to 50-50. Our revenue portfolio, as well as our ability to, and the profit margin profile, which you mentioned in your initial comments, that taking it up to double digits, closer to 10%. That is very much the target broadly with the companies working towards. There are good tidings that we have within the edible oil portfolio itself. For example, our oil palm is doing exceedingly well. And there we make 17 to 18% margin. And every year we are adding nearly 50 to 60 crores to the margin, to the bottom line straight up as more plantations get matured. The edible oil portfolio is the one where we have to be both measured in our expectations. And there again, what we've said is that between 2 and 4% margin on the edible oil side, we should be able to make. And if we are able to do that, then we should be very close to double-digit EBITDA in 4 years' time. And revenue construct, which is closer to 50-50, what we said. But then what I'm doing is that we're keeping the prices as stable to the 25, 26 numbers, and basis that we're calculating. Now, if the prices were to go down on the edible oil side, you might see this maybe in the 4th year itself, that this might pretty much play out, that our growth rates will start to match 50-50 that we're talking about. We should pretty much get there.
And nutraceuticals, where does that fit in? And are those margins significantly different from the overall portfolio otherwise?
So maybe I'll take this opportunity to the question to explain how the margin construct in the various businesses are playing out. So to answer your question straight up, nutraceuticals gives a margin of 25 to 30% on a consistent basis. We had initial challenges after the breakneck pace at which we had grown to nearly 400 crores of revenue on the nutraceutical side. We took a step back, restructured the portfolio. We redid the entire branding exercise. There was a lot of learnings that we got in terms of how the nutraceuticals were getting consumed in the country. Product offering that we had, the SKU mix we worked on, and substantially changed that. So now we are at a point where on a gross margin basis, we typically get about 40 to 45% margin that we make, and then we rearrange the entire organization also around that to that level to suit the lower level of sales. And about EBITDA basis, we do about about close to 25 to 30% is what the EBITDA we do on nutraceutical, but the base is very small. So really, in terms of the overall contribution to the company's profit profile, there is it doesn't really contribute to that extent. But in the years to come, we are maintaining that growth rate of 25 to 40%, and we'll consistently sort of do that from a small base. Coming to the HPC businesses, we do anywhere between 16 to 18%. We did about 22% also, but rationally, pitching it at 16 to 18%, which we are growing the top line and will help our bottom line increase as well. On the Nutrela businesses, our consumer business division, we do about 18% consistent margin. It's a top brand in its category. We do very well there. Likewise, in the oil palm business, our margins are 18 to 19%. Last year, for example, these are declared numbers. We did nearly 357 crores of EBITDA in the oil palm, and it'll keep going up anywhere between 50 to 60 crores year on year. And biscuits, we will do we did last year about 2,200 crores of revenue. And our margin is at about 15% there, what we've done on EBITDA basis. So that is a very good number. And we propose to grow anywhere between 20 and 25% on the biscuit side. The two areas in which, we need to be more cautious. One is the edible oil, clearly. I mean, what we import and refine and sell. And second one is, of course, in the staples food category. So we are very good on the ethnic food side, where the margin construct is good. In the staples category, because of various reasons that we discussed on the input inflation, clearly may have an impact on the overall in the way prices, the margins play out, and occasionally that has an impact. So net pretty consistent paths that we've taken. We need to grow the top line. We need to maintain the bottom line in the way we're going. Watch out for the risks management on the edible oils, which we believe that in an inflationary environment like this year, we should do much better. And the staples, of course, as we spoke, that the various measures which might be there, so that we will continue to work on. So detailed answer to your question on the margins, but should give you a flavor of how the company margin construct is there now.
No, absolutely. And Mr. Asthana, therefore, where should the blended margin lie? Could you give us some kind of a range? Would it be 4 to 6% next couple of years? Would it be 5 to 7? Is that something you're bullish about? And, given the current uncertainty in terms of the environment, would it keep you a little more sanguine with regard to your commentary on margins?
So clearly, look, I mean, I did mention. So while, based on some choppiness that we saw on the margin construct on foods and edible oil, so the margins did not keep pace. What we said was that we will maintain 100 basis points of increase every year on the margin construct in 5 years' time. From somewhere around a ballpark range of 5% plus, we should hit 10%. That I'm still sanguine about. I'm still positive that the direction is pretty much set, and we should, on a blended basis, we should pretty much go towards that margin. Three big efforts which the company is working on right now. One is clearly premiumizing the offering that we have for the consumers. So that effort, of course, has started several years back, but continues to gain momentum, where we are increasing the variants that we have and we are offering to the consumers. The second effort is in terms of the input, of course, the commodity inflation side we've discussed, but really our operating cost construct that we have. So there's a very serious attention that's being paid to that side. And the last part is, of course, our the management of working capital and ensuring greater financial control over certain aspects of our trading businesses that we have, the supply chain businesses which supply into that. So that's what the effort is going on. So I'm pretty hopeful that some of the efficiency efforts plus the growth in the FMCG, we should get there.
Sure. Mr. Asthana, cash flow, is that at all a concern? And when does the working capital requirement start to go down?
So you know that especially on imports of edible oils, we have you said in the beginning, the commentary, we are still debt free. The only limits that we've taken is for the working capital and certain LC limits. So pretty much, and there's no major need at the moment for major capexes or otherwise. So we're comfortable. Free cash flows are a function of course, the debtors and other changes that we have in the business. So that has been a bit of a dampener, but I think I don't expect that to continue longer. We are rationalizing some bit of requirements of the on the working capital front. The treasury sort of operations in terms of the money on the balance in the bank. I think will also improve, from the next quarter onwards itself. So I don't see any concerns on that. Yes, we can do better. Certainly, we should be doing a lot better. And that is one part that we're focused on, that how do we improve our efficiency of working capital significantly better. But the very nature of business, Harsh, is such that where, there's a longish cycle time that we have on the, so palm, for example, we have a 15-day voyage, from Southeast Asia. On sun, we have nearly 30 to 35 days. On soya, we have nearly 45 to 50 days. So really, the working capital cycle typically gets locks into a longer sort of term engagement on the side, and then once you get into the country, then it gets processed and refined and sold. So the turns of the inventory in a year, we typically end up doing 4.5 to 5. We should get closer to 7, and but that magic sauce of pushing in that direction is what the effort has to be. That how do we, the portfolio, the way we rejig our portfolio and purchase or otherwise, improve our cash flows from the operations. I think that work is clearly going on, and we should do better in the coming quarters on that.
Right. Mr. Asthana, last piece, very quickly. I want to understand, one, your capital allocation strategy, what's the capex in the pipeline? And two, what are you doing on the quick commerce side of things? Anything interesting there that you're pushing through in terms of that? Because it's a large opportunity, especially in tier 1 and metros. How are you playing it?
So on the capexes, it's fairly straightforward. What we said is that in 3 years' time, when the palm plantation starts to mature, we will have capex requirements of close to about $100 million, about 1,000 crores is what we need to put capacities in Andhra Pradesh, in Telangana, in Assam, and Mizoram. The Mizoram plant is already coming up, so that is broadly what we require, and Karnataka, one more mill that we're setting up, but that is extending. It will probably come in 3 years' time. Currently, we're using our own capacities, which are full up, so there's some marginal expansion. Immediate basis, we do 100 to 150 crores of capex every year, which is more largely a maintenance capex and some bit of tinkering, on capacity expansion or otherwise your packing, etc., that we put in. On the quick commerce side, the focus is very clear. The top 6 cities, the big metros, going to the next aspirational ones like 25 cities. That's where the big focus is on quick commerce side. Our proportion of business that we do on an overall basis is about between 2.5% is what we do through quick commerce. We'd like this to be closer to 4, and which is a very large number. So that effort is going on, and we will see a lot of progress on the quick commerce and the modern trade side and e-commerce. So that's pretty much one of the core targets which the company has of expanding our reach in that direction.
All right, Mr. Asthana, thank you so much for joining us. Really appreciate you coming and giving us that perspective. Of course, FMCG is the flavor at this point of time, given the fact that you're seeing decent underlying demand and those numbers as well coming in from some of the FMCG companies, keeping FMCG in focus. Completely timed out on this edition of All About Your Company. Thanks so much for tuning in.